Boom. Oh yeah, we live. Let's go. Yo, so I want to talk about a couple couple items in the loan process, and I actually just stole this information. I saw one of my other fellow loan officers make a video on it, and I was like, "Damn, that's brilliant! That's great information for clients." So I thought I'd share this with you. And man, what you're gonna hear some terms when you're when you're in the process of loan origination, depending on who your lender is. They may or may not do an awesome home buyers presentation. We always do for our clients after they get pre-approved. They jump on a Zoom call with me or one of my junior LOs if they're the ones who are working on their file. We go through a half hour to hour course on what is mortgage lending and what is the process. And there's some things that you're going to hear when you're in the process, and lenders like to use big terms because they want to feel like the experts and they want to talk about all the things that they're doing. And it's all pretty basic. It's all pretty easy once you have a good system to originate loans. But here's some of the terms that you're going to hear, and I'll do my best to explain it. The first is you're going to hear this term underwriter. When the lender talks about your file, and he's going to always, say, hey, this ain't for me, this is for the lender, or this is for the underwriter. Underwriter is a liaison in the lender's company. So they're a broker, a direct lender, a bank, basically someone in credit. They have the magic pen that signs off on your loan. And so what their entire job is to review all the paperwork that the lender has gathered. They're going to check out the automated underwriting results. So when we pre-approve a client, we run it through an automated underwriting system that's going to tell us all the conditions to get your loan approved. And so what the underwriter is going to do is they're going to review that document, and then they're going to compare it to the Fannie and Freddie guidelines. They're going to review your documentation, pay stubs, bank statements, W-2s, tax returns, P&Ls, whatever it is that they need based on the type of financial portfolio that you have. They're going to analyze all your financials, make sure the lender did their job properly. And so what's going to happen at that point is you're going to get conditional approval, and then the lender is going to call you and say, hey, great news, you're conditionally approved by such and such company's underwriter. And they're essentially saying, hey, someone in credit has signed off. So the analogy I could give for an underwriter is they're basically a judge, right? Like, you can think of us as attorneys. Probably none of us were anywhere near smart enough to go to law school. For sure, I'm nowhere near that smart, nor disciplined enough to sit there and read a book. I have too much ADHD. But you could think of us as like your attorney, right? We're battling for you to get a home loan, and we got to prove to this individual who sits behind the desk, this person called the underwriter, and they're basically the judge, right? They're going to make a decision on whether or not you qualify. For the most part, right, you're going to judge your loan officer on their wins, just like you would any other attorney. And so if you have a good lender, they're going to know how to fight the fight. And hey, sometimes these underwriters will take a make sense portfolio, and they're going to just botch it, especially if you got some kind of overtime or bonus income and you didn't get a BOE at first to qualify, or there's something wonky in how their finances are structured. They don't work full 40 hours. It could be times where a lender, especially if they're a newer lender, it's not that they just don't know how to do their job. A lot of times you haven't experienced oh shit, this is a guideline that can catch you slipping. And so the underwriter's job is to make sure that any holes are filled and any T's are crossed and every dot is dotted. And so what they're going to do again is they're going to verify all your paperwork, and then they'll say, hey, okay, all this looks great, you're approved, get me XYZ. If your financial picture is wonky, let's say you've been self-employed for a year and a half, you have tax returns, you actually filed taxes showing that you made a profit, so you actually qualify on one of your tax returns, and you got to get some exceptions. It's at that point that your lender's got to fight the fight, right? Look at the Fannie guidelines, which allows for 1 year tax returns, even if you haven't had the business for 5 years. And then learn how to present the story, right, of why you're going to be able to qualify with 1 year versus 2 years. Or on a VA loan, you want to exclude non-borrowing spouse debt. Maybe the underwriter is not well versed in VA underwrites, and they're just dabbling in it. And so you present your file, they hit the spouse's debts, you argue, hey, You don't have to because you're not a borrowing spouse and they have a job, they can support their own debt, so we should omit it. So little nuances like that, that's actually a good trick. So all my lenders out there, and take note of that in case you didn't know. And so, you know, their job is basically to approve or deny loans, set the conditions. Once you collect all the conditions, right, this is where the lenders go back to you, say, hey, I need X, Y, Z. By this time you're frustrated, you probably hate us a little bit, and then when you get us what we need, and we submit for clear to close. You know, that's a big part of it. But, you know, really their job and our job comes down to analyzing one thing. That's debt to income, right? Credit scores aren't that heavy requirements, right? 580 for FHA and VA, 620 for conventional. The truth is, unless you have like 20% down with plenty of reserves, typically conventional above 680 is going to be cool. Like below 680, you're going to have a hard time getting an AUS automated underwriting approval, and so it's going to be tough goes at that point. Usually, anything below 680, you want to flip to FHA. And so, so what we're trying to do and what we're looking at is really just trying to analyze how much you make versus how much you owe. So can you support your monthly obligations plus your new mortgage, and support it with your overall income? So for example, if you make $8,000 pre-tax, we're going to say, okay, your debt to income cap is $4,000 on conventional financing. So if you have $500 on a car payment and, you know, $100 in student loan, that leaves you $600 in debt. That leaves you with $3,400 for a mortgage, which, depending on your down payment, could be anywhere between $500 to $600, maybe even $700. We have a large down, and so that's really what we're doing, right? We're trying to make your portfolio fit into a box and make sure that when the underwriter analyzes your financials, you're within the debt to income ratio. Again, your debt to income is just how much debt can you afford based on how much you make. That's really what a lender's job is. That's what we do. And so if you have any questions, just holler at me, shoot me an email, tony.pelayo@apmortgage.com. We're really good at different type of financing. And so if you have a loan right now that's in underwriting and is in trouble, go ahead and drop an email below, or contact us, and we'll be happy to get a hold of you, review what's going on, review your conditional approval, or review your suspension, and see if we can help save your loan. Peace out, y'all. Have a wonderful day.